Let's now welcome on board Mihir Vora, CIO at Trust Mutual Fund, joining in on the show right now with his take on the markets. Mihir, hi, morning. Good to have you on the show. Nothing really has changed, right, since our last conversation. We were still in wait-and-watch mode, and in that wait-and-watch mode, look how much FIIs are selling India, Mihir. And we were just looking at the data points. It's been quite an excruciating sell-off, come to think of it. 5 consecutive weeks of decline. Seems that markets have pretty much digested both tariffs as well as earnings softness back home.
Hi, good morning. I won't say the markets have completely digested because the markets have gone down in spite of local buying. So I would say the sentiment is a little bit cautious, optimistic but cautious. What has also happened is that we did see some dollar recovery, in the sense the dollar had been continuously weakening since February. In the last couple of weeks, we did see some dollar strength. I think it's more of a technical bounce. DXY going from 96 to almost close to 100. But on Friday again, you saw that there was a correction again. So dollar structurally continues to remain a weak currency. So in general, I think as long as things are not too uncertain, we should continue to get money from FIIs into India, barring these fluctuations. But I think the bigger issue is the fact that certain domestic growth indicators are still not picking up to the extent that one would hope they will. For example, banking credit is one of the biggest indicators, and we are still at almost high single digit kind of a number, which is not sustainable or not compatible with the expectation of a 6.5% GDP growth. So we do need some of those indicators to pick up to get the confidence that the current assumption that the second half will be better, that has to pan out.
Right, Mihir, morning. Hi, this is Mihir also joining in. Since you just said the markets have not fully digested the overhangs we have, do you believe we're in store for some more consolidation, or would it now be the correct time to say that the markets have bottomed out and now we can head for some recovery?
I wouldn't call either a top or a bottom at this point in time. I would take it a day at a time because there are a lot of moving parts. Tariffs is one. As I said, some of the macro indicators of growth, etc., need to be monitored closely. We need some improvement there. So I would say we should take it one day at a time. I'm not very bullish or very bearish at this point in time.
Here you did flag off the credit growth concerns when it comes to banks, and one has seen that play out pretty much across the board, wherein there are cases of high provisioning pretty much for all banks right now. How do you dissect now within banks? While sure enough the large ones need to be part of your core portfolio, but what about the entire bottom-up approach? What about the smaller ones?
We are still sticking to the larger private sector banks, though we have some exposure to PSU, but not much. The call being that pricing power both on the asset side as well as the liability side tends to be a bit higher with the larger private sector banks. Of course, since they are since they typically have a diversified portfolio, they may not be the fastest growing, but in terms of structural pricing power and the liability management, the larger banks tend to be a bit stronger. So as of now, we are sticking to the larger private sector banks.
Right. And Mihir, the kind of news flow we've received from US in terms of a tariff rate, 25% seems tentative at present. We still don't know what the final figure could be. Amid such uncertainty, how have you rejigged your portfolio at all? Where are your current overweights and underweights?
Sure. So we've not really rejigged the portfolio based on the tariff situation because, as you said, it is still a fluid situation. It's never over till it's over. As you know, with President Trump, negotiations will go down to the wire to the last day, so to say. So we're not taking big calls based on the tariff situation. But I would say that in the last few weeks, we have been mostly retweaking or readjusting the portfolio based on results. So we have reduced a bit of exposure to banking based on results. We have reduced a bit of exposure to IT, where we were overweight to start with, but we've gone further overweight on the large cap IT stock based on the results. So most of the rejig has happened after looking at the results and the trends.
Interesting. That's the case when it comes to the earnings. But other than financials, Mihir, do you sense that largely there has been that softness in earnings? I mean, even if you were to look at the commentary, for instance, and we were just chatting about this morning as to the contrast from what you heard from L&T and then ABB. I mean, ABB is pretty much hinting at a cyclical slowdown, and L&T on the same hand is talking about the private Capex growth. So one hasn't really seen a big upgrade play in so far in this earnings season.
It's been a mixed bag. For example, some of the capital good pockets have demonstrated good results. My guess is that the government spending continues. So the segments linked to government spending like railways, transformer, defense, some of the infra names in construction, etc., should continue to do well. On the companies which rely on private sector capex, I think that's where the earnings are mixed. But I would say that given the overall traction that's happening on the PLI front, etc., private sector capex on a granular level should improve. Plus, you might see some upside surprises in the next few years in capex for green hydrogen, for blue hydrogen. Plus, we are now facing not only issues on various chemicals, etc., but even on fertilizers. We saw that China has started squeezing us. And fertilizer plants are very large capex items, and the government is actively looking at boosting domestic production of fertilizer. So that can be a large bunch of capex that could come. So I think the private sector capex has slowly but surely picked up, and we can see a multi-year cycle, though it may not be as sharp as the cycle that we saw between 2003 and 2008, but I think it should be a good upward sloping cycle as far as private sector capex is concerned.
So sounding optimistic on private capex, but Mihir, how are you positioned when it comes to pharma? Because once again, that entire 200% tariff uncertainty still looms on that sector. So any sub-pockets you're liking, or are you completely avoiding this space at present?
So let's talk about healthcare rather than pharma specifically. So in healthcare, we have exposure to diagnostics, we have exposure to hospitals, and we have exposure to some of the manufacturers in the CDMO space. We've been kind of underweight on the pure generic US plays, not so much because of tariff concerns, but because of the fact that margins, etc., were a bit of a question mark for a while. And CDMO is where a lot of the incremental business and a lot of incremental activity is happening. So some of the R&D oriented players, CDMO players, the diagnostics space and the hospital space, that's where we are preferring to play the healthcare segment.
Okay, that's the take coming in right now on where is it that one is seeing the opportunities in the market as we speak right now. Just looking at the market texture, it's really some of those earnings specific movers, be it an MCX, be it delivery. There's Pidilite, which is also holding out, BEL ahead of its earnings later this week. That also is looking good by about almost 2% as we speak. I think the silver lining today is that the breadth of the market, at least within the F&O segment, that's jumped up quite nicely. It's opened nicely. 179 stocks is what you have to the greens, with just 40 odd to the reds. And that's really definitely a heartening sign as well. But just looking at some of the other earnings, how they've played out. Mihir, do you believe that FMCG or staples as a segment, one has seen positive earnings playing from most of these companies? What perhaps aided also was the fact that they had been consolidating, they've been seeing weakness in their businesses as well. So thereby, perhaps optically, it looks like a, meteor performance this quarter. But do you think tactically, staples is it right now?
Tactically, probably yes. As you said, there are some base effects playing out there, including raw material price effects. And the companies have been doing their pricing accordingly. So I'd say that from the margin point of view, things look fine. From the demand point of view, if you look at the results, it's been a mixed bag. There's no clear trend that demand is definitely picking up. But the commentary from the companies has been overall positive. So one hopes that the second half will be better than the first half. And the fact that we are hoping, and the buzz is that rural economy seems to be coming back. that should help the FMCG pack because they typically tend to be in the lower ticket items consumption space where the rural economy has a larger say.
Well, yes, of course, off late the FMCG pack is shaping up well. But with this, we let you go on that, Mihir. Thank you so much for taking the time out and speaking with us this morning.
Thank you. Always a pleasure.